I would be saying that. I'm like,
sorry, I was raised to be a gentleman.
yeah.
Actually, I'm not sorry.
Let me know who will be hanging out with me.
Same place.
This is a lot of
Emmanuel.
information.
Throw me the water, please.
Oh, we can have
Alright, what is this T and C?
Oh, no.
Is this a Bernie and C's or something?
Be quick about it.
so we can,
What is HI?
Tonight I got a lot of families in there.
I just need to.
almost what you need to.
Guys.
Girl, almost doing her bag.
Okay, if you guys want to, listen, we're covering this material, you should take notes, you should pay attention. I think there's some questions from this on the quiz on Wednesday, so.
There usually is.
Dude, this test, I took this test yesterday, I got 100. I did the test in like 10 minutes, and I got 100.
Give us like 7.
Sorry?
So you need to give us 20 minutes. So you got to still 3 minutes for the test.
No, because, listen, it's funny, I told her. No. Listen, I'm trying to be fair, I'm trying to be consistent, so this quiz was always given after class, so it was the focus of it was so that people would pay attention during class and take notes. So what happens now is look, I ain't dumb, you guys sit there, you got your notes all next to you, and the reason I know is when I see stupid answers, it's like somebody regurgitating exactly what they wrote on a note. And they're like, okay, I have no idea what the answer is. Well, let me just throw all this stuff, you know, like, and the more I throw, the more it'll stick. So it may or may not. So no, this is like super simple. But you got to. The purpose is not to give you enough time that you go to your notes. Although, see, if you got your notes, I don't care. If you're learning this stuff, I don't care. If you all get hundreds, great. It means you actually read the notes and you had them handy, and you could answer simple questions. These are really, really simple questions. Okay.
Yeah, but my theory is if it took you 10 minutes, you should give us 20.
No, it took me like 3.
No, you said
right.
10.
No,
You said 10.
I put it together in 10 minutes.
Roll back and say.
Okay, listen. So look, I originally had like 90 minutes to do this. I'm going to do it in less, but because unless you guys want to stay.
No.
This spreadsheet still my hand.
Right? I wanted to spend just a few minutes in this program talking about taxation. Okay, and taxation is an issue that I mean, in and of itself is an entire program. It's an entire class, and it potentially is an entire master's program, and it potentially is an entire career. And I am not by any means a tax expert, okay? And so what you're going to get from me is a very sort of soft overview that hopefully will let you know that you need to be aware of tax ramifications or tax implications in your real estate transactions. And you need to, as I've suggested in the past, just like you should always pull in the best architects and the best attorneys, pull in the best accountants when you've got a situation. When you got to deal with structuring a situation, when you get a letter from somebody in the IRS or Department of Revenue or something, call in professional help, because the whole tax area is an area which requires a high degree of specialization and of knowledge. And most people that are generalists that work in this industry, and we have to be generalists to work as developers, we just can't know enough about a particular subject to do it all on our own, okay? I'll just kind of start by saying, tax, curious, so what's tax? What's a tax? What's a tax? in Spanish, the word is impuesto. Right, in French, I think it's spelled impost, right? It's something that's imposed on you, right? So it's kind of a burden. It's a burden, right? So, curiously, you can look at it as an imposition, right? So it's an imposition, but from a very socialist perspective, it's redistribution of wealth, right? So, I mean, it's, so you take from the rich to give to the poor, right?
No, it's the reverse here.
What? You take from the poor to give to the rich? Okay, maybe that's the wrong concept, but, and then another way to say is it's really a gathering or a commingling of funds to pay for common services, right? So, at the end of the day, when governments tax people, yeah, you could look at it as an imposition, right? It's an imposition to pay for the structure that governs you, right? It's the animal that you need to feed the animal in order to let it govern you. But it could be a redistribution of wealth, right? I take money from you to buy, to give housing subsidies to this guy, or food stamps to this one, or student grants to this one, or whatever. Or the last one is commingling of funds to say, hey, I need a military, I need to hire a guy named Quincy to go off to Afghanistan or wherever he goes, okay? And I got to pay his salary because I got to build roads, I got to have a police force. So governments use taxes for a variety of all of these things, right? To feed themselves, to redistribute wealth, and to pay for common funds. Now, basic premise that I'll leave you with, and I've said this before. Tax law is one thing, accounting and financial reporting is something different. And one has nothing to do with the other. So what we've talked about in this class is financial reporting. We talk about how developers or other companies report to their shareholders, to their lenders, to other interested parties. We haven't talked about how you report to the government. How you report to the government is not under GAAP. It's under a totally different series of rules, okay? Tax law. And so it has nothing to do with GAAP. It may look like GAAP sometimes. You may have to report a tax balance sheet. You may have to report something that looks like an income statement, but it's not an income statement and it's not a balance sheet. So the tax law is going to require certain information from you, ultimately to help them arrive at a number that they're going to nail you for, or jack you for, or whatever language you use, okay? So, as a company, we need to maintain our GAAP records for financial reporting, but we also need to maintain a different set of books or records or accounts for tax purposes, okay? Now, a lot of times, the smaller a business is, the more that their financial reporting is really tied to tax reporting. They only keep books and records because they have to do a tax return at the end of the year. As you get bigger as a company, you maintain financial reporting because you need to inform yourself or the other shareholders how you're doing, and then you keep a separate, so if depreciation is kept for book purposes a particular way, you need to keep a separate, record of how you're depreciating for tax purposes. Noah?
Why do you think your buddy Donald's not releasing it?
My guess would be because my guess is because he's always tried to make people believe that he's like filthy rich, and he's nowhere near as rich as he makes people out to be. And I think my thing is pure ego, and he's probably not worth anywhere near what people imagine.
Right.
That would be my sense. But we can talk about that. Let's
It's all not even
All right, I'm done.
Is this a Donald question?
Nah, I don't care.
And he's not my friend, okay? He's not my friend.
Why is it that when you go to borrow money, they ask you for the tax financials and not GAAP?
No.
Or not?
Banks always have, the reason, especially as a small businessman, the reason banks ask you for your tax return is because the question is going to be, if you're reporting something, most small businesses aren't audited and all that, but your tax records typically are going to be something that's subject to audit, and it's something that you presumably have sent to somebody under, potential criminal,
Consequences.
criminal consequences, and so they're just looking at it as validation, and most small businesses maybe don't even do financial statements on a recurring basis, but they'll all have a tax return, okay? On a personal level, it's because you're obligated to report the real income that you've had, not what you're purporting to have, right? So if you got a W-2 or 1099, you're gonna report it, and that's what the bank's gonna say, okay, that's really what his income is, okay? Couple of basic assumptions in tax. The basic assumption is that any cash you receive is going to be construed as income and is going to be subject to tax. And the other basic assumption is that any expense that you incur is not going to be deductible unless it is specifically authorized to be deductible. So it's kind of from an individual perspective, the worst of all worlds, So the basic presumption, you get cash, it's income. You incur an expense, it's not deductible, unless the law specifically allows it, okay? So, again, kind of a cynical view, maybe that's a personal view, but that's really the way the kind of income tax code is sort of, based, I'd say. So the tax code allows you to use cash or modified cash or accrual basis of accounting. Okay, when you're a corporate entity, so you could use cash, you could use modified cash, or you could use accrual basis of accounting. But because they are going to deem income and expenses what they deem them to be, they're not GAAP records. So you could report an income tax basis set of financial statements. It could be built on a modified cash basis, on a totally cash basis, or on an accrual basis of accounting, but it is never GAAP. Income tax basis is never GAAP, okay? So income tax basis is you're following the income tax code or rules. I don't want to complicate things. But for GAAP purposes, we recognize that tax exists, okay? And we report theoretical taxes for book purposes. We don't recognize actual taxes, but theoretical taxes. That's all governed by a FASB called FASB 9, okay? Statement of Financial Accounting number 109, okay?
What is theoretical?
I'm going to tell you that right now. So when I say theoretical, I mean theoretical because you don't pay taxes in a theoretical world. You only pay taxes to the government, okay? But I'm going to give you a hypothetical example. Let's say that for GAAP purposes, you had $1,000 worth of net income, just for hypothetical purposes, okay? Let's do a better example. Let's say that you had earnings before depreciation of 1,000, okay? You had an asset that's worth $1,000. For book purposes, you are going to depreciate that under a useful life of 10 years. That means this first year you're going to have depreciation of 100, okay? Which means you're going to have taxable income of what? 900. Assuming that your tax rate is 50%, just to say something easy, right? You're going to pay $450 worth of tax, and you're going to have net income of $450, right? Make sense? So far, you're with me? Do I get an amen?
Amen.
Do I get an amen?
What's the 450?
Net income.
No, 900 minus.
Taxable income, this is tax.
Okay.
You have taxable income 900, you have a tax rate of 50%, right? So you have net income or income after tax of $450. Now, so for book purposes, you're going to show on your financial statements that you have tax of $450. But now, 3 months later, you're going to do your tax return, and tax law says, hey, you can depreciate this in 5 years. why not do it, right? You don't want to pay the government money, right? So when you actually do your tax return, instead of having depreciation of 100, what are you going to have depreciation of? 200. Right? Which means you're going to have a taxable income base of, or taxable income of 800, right? If your tax rate is 50%, how much tax are you really paying to the government? 400, right? Which means you're going to have 400. Wait. Right, 400 of net income afterwards, right? For tax purposes. Now, you got this so far? I'm going to do a journal entry real quick. Real simple journal entry. Okay? Okay. What is my income tax expense? Okay, let's try door number 2. 450. What is my income tax payable? 400. The journal entries have to balance? Where are those $50? What do I do?
In your pocket.
Next year's tax.
Okay. We create something in the balance sheet called deferred taxes, which is a liability, which basically recognizes what we call timing differences. Okay? And so we create an account called deferred taxes. They could be liabilities, they could be assets, which essentially account for the timing difference that exists between theoretical taxes and actual taxes paid. And the reason you do this is why? Because 5 years from now, it's going to turn the other way. You're going to have more tax liability than expense. And what we want to account for is actual incurred tax, not what we paid today. Okay, I just said a whole bunch there. Do you want me to repeat it? Yes? No? Okay. All right. So, for book purposes, FASB 109 tells us that we've got to account for income taxes. So we account for income taxes on a theoretical basis, okay? We use statutory tax rates, we use book income, right? There are certain items, and I use depreciation as one that could give rise to what we call timing differences. Timing differences are areas in which GAAP gives us guidance that's different than what the tax laws require. And as a result of that different treatment, there's going to be a difference in the current period between the tax that we pay currently and what we theoretically would have incurred. You don't need to know the math. I'm not going to give you a test on this. I'm just trying to highlight a point. So when you see deferred taxes on a balance sheet somewhere, it'll jog a light in your mind that says, hey, that has something to do with timing differences. And timing differences have something to do with the fact that there's a difference between GAAP and tax law. And that's all you need to know. I'm not going to hold you accountable for any of this. But I do want you to know that there's a concept called deferred, which could be assets or liabilities. Okay? Which means you may be recognizing income earlier or later for tax purposes than what you did for book. Yes, Emmanuel?
Would that be the same deferred taxes on a capital gain?
Okay. There is a difference between what we call permanent differences and timing differences. If a difference is permanent, if, for example, a deduction that is allowed for tax purposes is not something that we contemplate within GAAP, or said a different way, if an expense that we recognize as an expense is disallowed for tax purposes and will never be recognized, that is a permanent differences. And we do not recognize deferred taxes for permanent differences, only for timing differences. Okay? So if a difference is never going to reverse, one way or another, we're not going to recognize it. We're going to use statutory rates. If you're subject to capital gains treatment, we're not going to use ordinary tax rates. So we're not going to create timing differences because of statutory rates.
Did you get that?
Yeah. I'm gonna put back the video.
Easier.
Okay. Listen.
Put the video.
Listen, I only drew this out to show that, again, there are things called deferred taxes. You're going to see on a balance sheet, all companies have this. And all it is recognizing the timing differences that exist between tax law and GAAP. If you remember that, that's all you need to know. And I don't even think that's on the quiz, so don't even worry about memorizing it. But I still have time to modify it. I kind of like that, so I can add another question if you want.
Can we go over basics again, please?
Yeah, this is.
Okay, so that's all I want to cover there. Okay, listen. So, and we're going to go through. I'm just going to mention so that you can jot them down and just have them as you know, sort of something in your mind. As with all other industries, real estate has significant differences between the way the government looks at results, at the recognition of revenue and the recognition of expenses than GAAP does. Okay, so I'm going to go through some of the major code areas with you so that you've got a little bit of an idea of, we've talked about some of these, but we'll talk about that. Before that, there's a couple of things, and we said some of this before. Ultimately, taxes in this country are governed one way or another by all three branches of the federal government, right? So those legislative branch enacts regulation, right? So ultimately, when you talk about incentivizing, Claudius, when you're talking about earlier about, you know, the government provides incentive, tax code is an area in which the government, through regulation, tries to incentivize different things. It could be home ownership. It could be investment, okay? It could be investment in certain technologies. And they use all of these things, right? So there's tax credits for this and tax credits for that. It incentivizes home ownership by making interest on home mortgages deductible. So it creates policy, all right? And so taxes are affected by legislation. The executive branch has to essentially enforce, right? And typically that's done through the Department of Treasury and in particular the Internal Revenue Agency, okay? So the IRS. So typically the executive branch through the IRS at least governs federal taxation matters. Okay, and hopefully following the legislation that's been enacted. And our judicial branch, right, ultimately deals with what? Disputes and interpretations of the law and the enactment. Okay, there is a separate tax court in this country, so you typically have the option of dealing through tax court or through the normal appeals court process. Okay, so ultimately the tax court goes up to the Supreme Court though. So if you follow one or another, you ultimately wind up at the Supreme Court. Taxes, so why was this country founded?
Why? 104 years ago.
No, not when, why? Thomas, you know that, you grew up here, right?
Most people are paying tax.
Okay, what,
Tariffs
we have
on
something
tea.
called what? The Tea Party, right, in this country? What is it? Well, there was a Tea Party in Boston. And what does the Tea Party stand for in this country?
Which state?
No, you guys, it's called Tax Enough Already.
Really?
You didn't know that? So, no, it's not, no, I'm not playing on this. So, obviously it's a play on words, it goes back to the original Boston Tea Party, right? But, so we found this country, right? This country's founded in a large extent because they don't want to pay the Englishman his due, right? They don't want to give the king his taxes, right?
Enough already?
Taxed enough already, okay? So when this country's founded, there's a bunch of things that the federal government has a right to do and a right not to do, right? And it gives the states certain responsibilities, and the states then give municipal governments certain responsibility. One of the responsibilities that the federal government does not give itself is the ability to tax its citizens. It would make sense, right? Why, if you don't want to pay taxes to the Englishman, why would you want to pay taxes to Washington, right? So when do federal taxes come into play in this country? Any idea?
The war?
What war? We've had several wars. Civil War?
No,
1913, the 16th Amendment to the Constitution gives the government the right to lay and assess taxes on its people. So until 1913, in this country, there were no federal taxes. What's the marginal tax rate today on an individual basis?
10 to 39.6 plus
So you're-
3.8.
You're 40% federal income taxes and for corporations. So, in essentially 100 years, so we existed for 100 and something years without giving the federal government federal income taxes. And in 100 years, we've gone up to 40%. Now, no value judgments, okay? I'm just giving you facts.
How did they
You said
pass
that's
the
a tax what?
additional
So,
affordable care tax?
The 40%?
That would be really too much.
well, that's the maximum marginal tax rate today. It's like
Yeah,
39.6%.
39.6 or 408 and up as an individual, and then they tag you with 3.8 for the
So-
affordable care on top of that.
So listen,
It's ridiculous.
what is it, jacked? What's that, was that the word you used, jacked?
Get Jack anyway.
Okay, so, listen, no value judgments, I'm just saying, up until 1913. 1913 is a critical year. That's the year the Federal Reserve is also created in this country. And there was a huge banking crisis. We were right on the heels of World War I. And, ultimately the government's looking for ways to finance, what was the first thing I said? They've got to finance their own internal operations. Now, they had rights to assess other taxes, and there are different layers of taxation in this country. So we always get concerned with income taxes, right? So, just kind of, again, this is really a primer. This is a whole class in and of, whole subject, a whole master's in and of itself, right? But constitutionally, different jurisdictions have different rights to assess different taxes, okay? So, states and municipal governments always had the right to assess income taxes, and they had rights to assess certain, type taxes, right? So, states typically finance themselves historically with sales and use taxes. That's how Florida finances itself today. We don't have an income tax in the state of Florida. We're one of a handful of states that still don't have an income tax, right? But most states have an income tax, right? And then there's a whole series of other taxes that states can assess. So they've got franchise taxes, utility. There are taxes on, there are excise taxes on the consumption of alcohol and fuels, okay? How do municipal governments finance themselves, or municipal organizations primarily? Typically property taxes, that's typically their purview, right? So we become, and so school boards, fire, so education, fire, life safety, right? Local government, those typically get funded through property taxes, which obviously impact real estate significantly. Emmanuel?
Where would the business tax receipt fall under?
Well, so there are, when we talk about property taxes, there is real, right, and there's tangible personal property, right? And then there's also intangible property, right? So what's intangible property? It could be patents, licenses, copyrights. In certain states, under state law, for example, in the state of Florida, an intangible asset could be a security, a financial asset. Okay, so states also charge intangible taxes, okay? Okay? So anyway, at a county level, you see properties, we're very familiar with real property taxes, but most companies have to pay intangible personal property tax on the things they have inside the business. Photocopiers, office furniture, etc. That's typically all paid to a municipal government. I don't know exactly what you're referring to, but you may be referring to a sales or a use tax, which is based on the receipts of what you sell every month to an individual.
Well,
Consumption tax.
it's like one of those, like that you gotta hang up in your office, like.
Well, you're talking about municipal license.
Right.
So those licenses are typically locally. That's typically more of a fee, an annual fee, than it is based on your volume. Okay? Noah?
Do they still have the gas guzzler taxes?
Well, there are excise taxes that are charged on
That's a state
fuels.
level.
Well, there are also federal excise taxes, right? All right, and so you see that on fuels, you see that on alcohols, you see that on luxury items, boats,
Yeah.
etc.
I thought Palm Beach County had that for gas.
There may be surcharges at municipal levels for that as well, okay?
Like when you used to buy a nice car, they hit you with both. The luxury, the gas.
Well, so again, listen, I'm telling you, it's a whole level of discipline. This is the single biggest component of federal income is the income tax, okay? So, there's unemployment tax that's paid here, there's unemployment tax that's paid here, there's, the FICA contributions, right, for Social Security. So there's a whole bunch of, but ultimately, on income is where the federal government finances itself, okay? And that's what we're all sort of usually concerned over. So there's all kinds of legislation. 1913 comes around. The federal government now has the right to impose income taxes on individuals. And so a bunch of laws start getting passed. And in 1939, under Title 26 of the U.S. Code, the first Internal Revenue Code, or the codification of internal revenue laws are embodied. So in 1939, so we go 1913, a bunch of laws. In 1939, those all get codified as one, as what's called the Internal Revenue Code. There have been two modifications to that. 1954, I believe, and then 1986 was the last time that the tax code was modified in this country. So it's, I don't know how many pages high, it's all over the place. That's why when you hear candidates saying, hey, Steve Forbes, hey, flat tax, simplified taxes, it's a whole business, right? It's a whole business of trying to navigate through all of these interpretations of law, enactments of law, interpretations of law by executive branch. And as we talked about in the capital markets class, we kind of go from regulation, right, to what? Innovation, right? And so, people say, well, the guys that have money always don't pay taxes. Well, they're paying their accountants and their attorneys to innovate, to bypass or circumvent or take advantage of regulation, which then creates more opportunities to continue to create, ways to create ways to avoid or minimize taxation.
You can bump yourself to a lower tax bracket by paying your
Is it
accountant,
likely they could be paid more?
Just pay your accountant more so you go a dollar over.
Is it likely they could be paid more legal fees and taxes?
Well, if you're paying a lot of legal fees, hopefully you're paying lower taxes. And if you're not, you should fire or just not use your advisors. But where you typically have an opportunity to do that, and especially in real estate, is on the structuring side. And that's why, I keep telling you guys, when you're going to enter into a transaction, that's why it's critical to have a good team of accountants and attorneys at your side, because you want to be able to create or structure a transaction in a way that when you ultimately unwind it, you're exposed to the minimum tax possible, okay? And we ultimately think in individual levels, it can get very intricate, right? You may have foreign investors, which are subject to certain laws, right? So you got to do the right thing by them. They don't want to be subject to withholding taxes, for example. You want to the extent that it ultimately falls on an individual, be subject to create hold periods that are subject to preferential capital tax rates, right? So, for example, I talked about that multifamily deal I'm in. The sale is structured so that it is sold after the holding period qualifies for the preferred capital gains rate. And while I'm on that, capital gains, I think I've said this before, a preferential capital gains rate is something that is applicable to individuals. It is not a corporate tax concept. So a preferential capital gains rate of, whatever, 28% or whatever, and it goes all over the place. Holding periods ultimately talk back to individuals. Corporations do not have preferential capital gains rates, okay? How we get guidance on tax laws is, and then again, this is for a whole sort of, course, but the Internal Revenue Code is primary. So we got what we call level 1 and level 2. Level 1 and level 2 guidance, okay? Level 1 has more weight than level 2. So the Internal Revenue Code, tax treaties, Treasury regulations, Supreme Court rulings, all have more weight than Executive Department, Treasury interpretations, okay? Appellate court rulings, legislative committees, okay? So whenever we take a posture, we want to be able to get as much support for it. Like when our advisors are helping us structure a transaction or account for a transaction, we want to be able to find the best support that we have so that if it ever gets audited, we have a leg to stand on. There are a series of sections that impact real estate. I'm going to give you a few of those. So in the Internal Revenue Code, we've talked about some of these. The first one I know we've mentioned in 2 classes, Section 1031 and Section 1033. What does Section 1031 deal with?
Transfer of capital gains.
No. What does it deal with? Door number 2.
Deferring tax.
Door number 3. We've talked about this multiple times. Like-kind exchanges. Okay, so some of the things that you said are consequences of Section 1031. Like-kind exchanges. What are like-kind exchanges? Theoretically, is when I exchange one piece of property for a similar piece of property. In a modern day interpretation in the real estate realm in this country, it means that I can sell real estate, put the proceeds in a qualified intermediary, and reinvest those proceeds in another form of real estate, and carry over the basis of the original real estate. So I am essentially, as someone said, deferring the income taxes on the gain. And because I get asked all this all the time, what are the general regulations on this? What are the sort of general?
You have to identify your
Okay.
45, 180.
So we've got a period of 180 days in which to accomplish a successful 1031 exchange. So day 1, proceeds need to go into a qualified intermediary. That's number 1. Within 45 days, we have to identify potential replacement property. Right? And then we've got 135 days to close. Okay? We can buy property that is more or less than what the gain we're deferring. If it's less, we only defer a portion of the gain. If it's more, we can defer all of the gain. Okay? So if on January 1, I sold the asset and the proceeds went directly to the qualified intermediary, I've got till February 15th to identify. What can I identify? I can identify, I've said this like 3 or 4 times, I think. Okay, we can identify 3 items, 3 specific properties, or we can identify 200% of the value that we're deferring with a limitless number of properties. Okay? So going back to using tax law as an incentive, the interpretations and the modifications under Section 1031 have definitely created an incentive for individuals to sell real estate and reinvest. So investment has been somehow incentivized, right, through the deferring of taxes. What is Section 1033?
Can I say something about 1031?
Yes, sir.
So I actually was just reading some of the laws, regarding 1031, and there has been now, I guess, a dispute as to whether or not flipping qualifies for 1031 if your entity is set up and structured, or defined as a company that essentially purchases, rehabs, and sells the assets, and they put a restriction on it. Where they said it's almost, it's too vague at the moment, but they're going into further depth looking as to whether or not you can perform 1031 with it.
I don't know anything about that, but if you bring the article, I'd be more than happy to read it, and I'd be more than happy to share that with the class. Again, I told you, I don't, flipping and residential transactions and all that, I think are a little bit outside of what I like to focus on in this program. Do we have a question over here? But I'm happy to look at it, because I know some of you have an interest in that, and that sounds like it might be an interesting, so 1033 we've talked about. This is a critical one as well. Eminent domain. What is eminent domain? When a government unit condemns your property and takes it over.
You have 3 years.
And basically they are similar rules to 1031, but your period is not 180 days. You've got 3 years to essentially reinvest. And the reason the government has given you that time frame is to say, you know, we've kind of inconvenienced you. All right? Okay. I'm not going to go into the details of it, but when we talk about it, we talk about Section 1231 property is property used in a trade or business, which could include buildings, includes real estate. Okay, so there's going to be rules related to recapture depreciation. What's recapture depreciation? What's depreciation? We know. What's recapture? Any idea? Okay, I gave you an example where we were depreciating an asset under over 10 years for book purposes, but for tax purposes we had an accelerated life, right? So tax law allows us, one of the incentives that the tax law creates is the ability to accelerate depreciation, to lower your tax bill. That incentivizes investment. People buy more because they can depreciate at a higher rate and they can lower their tax bill. But what, you know, one of the sections under 1231, if you sell 1231 property and you had accelerated depreciation, you need to recapture that. They'll say, hey, you can't have your cake and eat it. So if you're going to accelerate the depreciation, you got to hold the asset. If you're just going to flip it, you've got to recapture the depreciation. So that's just an example. So it's a code section, and it covers assets used in trade or businesses, including real estate. Specifically, Section 1250 deals with real property, okay? And Section 1245 is essentially everything that's inside the gut, right? So it's property that's subject to depreciation, but is not real property, but not 1250. Okay? So these sections give you lives, depreciation methods, etc. Okay? Section 754 deals with partnerships, which we use a lot. Okay? 167 specifically deals with depreciation. 865 is it?
What is 1245? It says property
Subject to depreciation, which is not real property. So when you're thinking in the context of a real estate business, it's elevators, escalators, mechanical systems, okay? It could be possibly drywall, it could be carpet, okay?
What is after 754?
Partnerships. Okay? 856 deals with REITs, so anything related to REIT is all. And one of the things that I had not mentioned, I think in one of the other classes, REITs, so REITs don't pay tax, right? We've talked about that if they conform with certain rules, but REITs can have what are called TRSs, which stand for taxable REIT subsidiaries. So we talked about one of the major So the major rules for REIT dealt with distribution of 90% of net income, right? One of the major considerations of a REIT is that its income must be passive income, right? Rents, for example. So can a REIT develop? Can a REIT develop? Development's not considered a passive activity. Okay, now, you can have a certain percentage. I don't remember, there's a certain percentage of assets and a certain percentage of income that you can generate in non-passive activities and still not lose your REIT status. So most REITs actually have a small component of their activities, typically what they're developing in taxable REIT subsidiaries. Okay, and as long as it's a small component of their business, they can have non-passive activities.
What is that small percentage?
I don't remember right now. You can take a look. I mean, I'm sure if you go to REE, you'll find it. But it's based on asset levels, it's based on income levels, and it may be based, if I'm not mistaken, also on head counts involved in those activities. How do we report to the government? Typically, we report to the government once a year for income purposes, but for a bunch of other purposes, so sales taxes, for example, we have to report every month. For unemployment taxes, we report, and payroll taxes, we report quarterly. We may have to pay more frequently than that, but we have to report quarterly. Okay, so we've got reporting requirements. That's typically what we call compliance with the tax law. For federal income tax purposes, the most common document that what we call C Corps file is an 1120. That's similar to what an individual would file as his 1040 at the end of the year.
As a form?
Form 1120. Okay, so it's got something that kind of looks like an income statement and kind of looks like a balance sheet. Okay, and based on what kind of looks like an income statement, the tax is calculated, but it's not really a set of financial statements. It's a form, which asks you for a bunch of information. Yes, Emmanuel?
Form 10K and 1120.
I'm not,
No, two different things. Okay.
Form 10K is a requirement under right, the regulations that requires publicly traded companies to file their annual statement, their annual report once a year. So this is a reporting of GAAP financials, okay, for investors. There may be a tax matters area that's addressed, or footnotes to the financial statement that deal with tax matters. There may be pending legal matters related to tax that are covered in the 10K, but has nothing to do with the 1120. I know you guys are like, I know you're tired. I know
Does
this.
it matter the size of the company? The
No,
form?
no,
The form?
no.
Everybody has
No, everybody, now, states have forms. So in Florida, there is no individual income tax, but there is a corporate income tax. So Florida companies file that after 20, okay, similar, all right? Now, in the real estate realm, we don't really see a lot of C Corps because we've talked about the fact that we always want to structure our real estate transactions in the most tax efficient form. And the most tax efficient form is some sort of disregarded entity, a partnership, a joint venture, an LLC, an LLP, an LLLP. Okay, there's a lot of different forms that exist out there depending on different state laws. So partnerships in general, okay, are going to file a 1065. And it is an informational return. Okay? They are what are called disregarded entities. Okay? So for tax purposes, they are disregarded. They do not pay tax at an entity level. And then what they give each one of their shareholders is a K1. And a K1 has their pro rata share of income and expenses, which they then report on their personal 1040s. income and expenses, credits, okay? So basically, it's information that you then pass on to your personal tax return on a pro rata share of the partnership that you own. Make sense?
I have a question real quick.
Yes, sir.
So, I was sitting down with some 2 days ago, we were talking about creating an SPE off of their heavily regulated group, because it's a capital group, so they're creating a special purpose entity, right? Would that then be regulated by the SEC, or could we have a PE branch of a group that is required to file?
Well, so, listen.
Do you get what I'm saying?
Public, yeah,
So that it's
but
less
I mean,
regulated?
you've taken the capital markets class. Public company reporting has nothing to do with Internal Revenue Service reporting. It's like it's like baseball and football, different sports, okay? You may be publicly traded, or you may have securities that are publicly traded or traded in the public domain, in which you have public company filing requirements, and obviously you're going to have Internal Revenue Service or State Department of Revenue or municipal level reporting requirements. But you may be a privately owned entity that doesn't have public company requirements, and everyone's got an obligation to file. You typically have a requirement to file, at least on an informational basis. I'll give you an example. There's an exemption. If you're an American that lives overseas, you can make up to a certain amount of money every year that is exempt from U.S. income taxes. But it does not free you from the information to provide, or the requirement to provide an informational return every year. So you've got to report. You've got to report whether you're to the Internal Revenue Service for tax purposes, irrespective of whether you're a publicly traded company or not. Yes, Emmanuel, and we're almost done, guys.
If I'm overseas and I'm making money and I'm not reporting in the United States, I mean, how do they know how much I'm making?
Well, so I'm going to give you a personal example. I have a sister who lives in the UK. She's still a U.S. citizen. She is not filed. She doesn't make any money. She's a housewife. She doesn't make any money. She has a legal residence in Florida. She doesn't make any money. She hasn't filed in years. Her son is going to FIU in the spring. Uh-oh, they want her tax returns. What have we been telling her? What's my father been telling her for years? What have I been telling her? So now she's had to file a bunch of tax returns. Thankfully, she hasn't made any money. But she should have been filing. She should have been filing, okay? Consolidation. We're going to talk about accounting for investments from a GAAP perspective next week, okay? We'll talk about all the, equity basis of accounting or full consolidation or whatever. For tax purposes, if you own 80% or more of the stock of a company, you must consolidate its results, okay? So if a real estate developer owns 50% of a partnership, he does not have to report it. If he owns 81% of an entity, his tax return is going to include not only his company, but also the subsidiary that he owns 80% of. Last thing, this question's asked has nothing to do with federal wealth. It doesn't have, because a lot of people ask. Most people's primary asset is their personal residence, right? So the law's gone back and forth. Right now, the latest iteration of the law is if you sell your residence as an individual, you can exclude up to $250,000 every year of your gain, or if you're married, up to $500,000, $500,000 of your gain is not subject to federal taxation. And that's changed. Yes, Thomas?
Only if you occupied as primary residence.
As a primary residence.
For 2 years in the last 5.
Okay, so you've probably gone through, you've probably just gone through
I
this.
read up on that tax code before I put my house on the market.
Okay, all right. So it used to be that your primary, the law used to be when it was better when I first got out of college. A primary residence, you could do like essentially like what a 1031 was. As long as you reinvested within 2 years, you could continue to defer. So as you got older and you made more money presumably, and you bought bigger houses, you could always defer the gain. but now you're capped at 250 or the $500,000. Okay, the only couple of thoughts on this, personal perspective, follow the law. We'll talk next week about ethical considerations, we'll talk about dealings with auditors, but with the IRS, don't mess with the IRS. You can sleep very well at night when you don't, okay? And if you do mess, you're always sleeping with that doubt. I mean, I've got a story. I used to work for these two guys, and one guy was getting audited, and he apparently had claimed something like $20,000 worth of charitable contributions. And this guy was a tightwad. He didn't give anybody anything. So we all went diving. We went like on a company dive trip, and a friend of mine was the managing partner of one of the big firms down here. And so we played a trick on this guy. He was sitting behind them, and he was going, "Oh yeah, I got a friend that just got audited, and he didn't have proof of charitable deductions, and he went to jail." And also, this guy turned out, the guy wound up in the hospital that night because he was so scared that he eventually found some pastor at some church that gave him a letter that said that he had really given the money when he really hadn't. So, but anyway, listen, don't mess with it. Don't mess with the IRS. No, he didn't get out. I mean, he didn't wind up in. Don't mess with the IRS. Don't mess with departments of revenue. State departments of revenue can be even tougher. Okay, I think I told you guys I got called once by a DOR guy. I got quoted in a newspaper about equipment we bought, and the guy's like, "Okay, well, I'm coming in to check that you paid sales taxes on all these purchases." Okay, so don't mess with these people. Generally auditors are very educated in a specific subject matter, and they're not necessarily pleasant or nice people. Okay, follow the law, cooperate. Here's my concept with that. If everybody complies, we wind up with lower tax rates, and if we wind up with lower tax rates, hopefully people comply, and it's a self-fulfilling prophecy. I mentioned what happens in Spain with people, sort of bypassing the property, doing all this. When people believe the taxes are too high, then they don't comply with the law. I'll leave you with this one. I'm a young auditor, the head of taxation from Kellogg came to Spain, and I'm having lunch with him, and I said something stupid to him. I said something about, I don't think companies pay enough taxes. I said, I think, I'm sort of populist, that I was young and naive, and so, whatever Bernie Sanders or Hillary say or whatever, corporations need to pay more taxes. And the guy was an older guy, he's a guy in his 60s or whatever, and he said to me, don't ever forget that corporations don't pay income taxes, individuals pay income taxes. And I've shown in this class, the bulk of proceeds, number one, the bulk of proceeds for federal coffers come from individual taxes, not corporate. And more important than that, managers and companies manage to net income, which is net of income taxes. So if their rates get jacked up, guess what? Their revenues are going to go up in the way of higher prices to you. So ultimately, individuals are the ones that pay taxes. And if we want to have a country that works like we have right now, we should all comply. One last thing I just saw, I'm glad that and I'm telling you, those of you left, you're probably not going to watch the video, you're not going to get the answer right on the quiz. Okay, I got this from the Journal of Accountancy yesterday, so it's kind of an interesting thing. This is how intricate the tax code could become, and I never even contemplated this. So imagine you're a tenant, and you get a tenant allowance. So you lease some space, and the landlord gives you $100,000 for you to go and do whatever. Hire an architect, pay for space planning. You could use it to buy out a lease. You could help it with moving expenses. What did I start the discussion with today? What does the tax law typically presume when you have income?
Power.
When you receive cash, what does it presume?
Power.
No, the tax, that was in the morning. If you receive cash, the general presumption is that that's taxable. So imagine you're a tenant, you got some cash for something, all of a sudden that's construed as income. But, because somebody thought about it, Section 110 of the Internal Revenue Code provides a safe harbor that says, basically, that you can defer that and amortize it over the improvements that you made or the lease term that you received, whatever it's covering, right? So, you sign a 10-year lease, you get $100,000, now you can amortize that income over the appurtenant lease term, okay? So,
What if
section,
it's a gift?
sorry?
What if it's a gift?
What do you mean, what's a gift?
Well, if someone give you a gift of,
That's for individuals.
Well, no, but, okay,
This is the
but,
company.
so look, so if you receive a gift, it's fully taxable, right? And it's deductible up to a certain limited amount, but if you receive a gift, well, whatever it is, but if you receive a gift, then it's subject to taxation. But, so tenant improvements, under section 110, have a safe harbor that allows you to not, have to recognize that income in its entirety year one,
so
so
what was that code number?
110.
Section 110.
So listen, with that, we're done for today. We covered a lot of material. Be on the lookout for the case study. Those of you who are watching, I would hope that you don't wait till the following Monday in order to ask your questions. Please start working on it early, okay? Listen, some of you got really good grades. It'll happen again if you put the time into it. So thank you. Have a great weekend. We'll see you in 2 weeks.
When do we get the update of the grade?